Banks are fundamental institutions in modern economies, playing a central role in facilitating financial transactions, credit, and economic growth. This article breaks down the essential functions of banks, their impact on economies, and how they generate profit. By understanding how banks operate, individuals and businesses can better utilize banking services for saving, investing, borrowing, and financial planning. The concept of banking dates back thousands of years, with ancient civilizations like the Mesopotamians and Egyptians conducting rudimentary financial transactions. However, modern banking as we know it started in Renaissance Italy, where wealthy families like the Medici established institutions to lend money, fund trade, and hold deposits. Banks evolved to become financial intermediaries, offering a range of services to individuals, businesses, and governments. The main goal of a bank is to manage money efficiently, facilitating savings, investment, and capital allocation across economies. One of the core functions of banks is to accept deposits from individuals, businesses, and organizations. Customers can store their money securely in various types of accounts, such as checking, savings, or fixed deposit accounts. Banks provide loans to individuals, businesses, and governments, enabling borrowing for various purposes like purchasing homes, starting businesses, or financing large projects. Banks act as intermediaries in processing payments and facilitating transactions through mechanisms like checks, electronic transfers, and debit or credit cards. Many banks also offer investment products such as mutual funds, bonds, and securities, helping customers grow their wealth over time. Retail banks cater primarily to individual consumers and small to medium-sized businesses. These institutions offer basic banking services such as savings accounts, checking accounts, credit cards, and personal loans. Retail banks often focus on customer service, convenience, and accessibility through a wide network of branches and online services. These are institutions that focus on larger corporations, governments, and institutions, offering loans, lines of credit, and treasury management services. They typically handle large-scale financial transactions and may provide advisory services for corporate clients. These banks specialize in helping companies raise capital through issuing stocks, bonds, and other financial instruments. They also engage in mergers and acquisitions, providing advisory services to businesses looking to expand, merge, or acquire other companies. In addition to retail and commercial banks, there are specialized financial institutions such as microfinance banks, cooperative banks, and development banks. These banks often focus on specific markets or social goals, such as promoting financial inclusion or providing credit to underserved sectors. One of the primary ways banks generate revenue is through the interest rate spread, which is the difference between the interest rates they charge borrowers and the interest they pay to depositors. For example, a bank may pay 1% interest on savings accounts while charging 4% interest on loans, profiting from the 3% difference. Banks charge fees for a variety of services, including maintaining accounts, ATM withdrawals, and overdraft protection. They also earn commission income from processing transactions, such as international transfers or currency exchanges. Many banks invest a portion of the deposits they receive into financial instruments like bonds, government securities, or other investment vehicles. The returns on these investments provide an additional income stream for the bank. Investment banks and certain commercial banks engage in trading securities, foreign exchange, and derivatives. Additionally, banks offer advisory services for mergers and acquisitions and capital raising, earning fees based on the success of the deals. Central banks, such as the Federal Reserve in the United States or the European Central Bank, play a crucial role in regulating and overseeing the banking system. They set key interest rates, control money supply, and establish reserve requirements for commercial banks, ensuring financial stability. Central banks use monetary policy to control inflation, stimulate economic growth, or curb excessive growth. By adjusting interest rates and buying or selling government securities, central banks influence the flow of money in the economy, impacting both the availability of credit and the cost of borrowing. Central banks also act as a lender of last resort, providing emergency funding to commercial banks that face liquidity crises. This function is essential to prevent bank runs and maintain confidence in the financial system during times of economic instability. Credit risk arises when borrowers default on their loans, failing to make timely payments. Banks manage this risk by conducting thorough credit assessments and setting aside reserves to cover potential losses. However, in times of economic downturn, credit risk can increase significantly, threatening a bank's solvency. Liquidity risk occurs when a bank is unable to meet its financial obligations because it doesn't have enough liquid assets. Banks are required to maintain a certain level of reserves, but they also rely on short-term borrowing and liquid assets like government bonds to meet their needs. Liquidity shortages can lead to solvency issues if not managed properly. Market risk refers to the potential loss that a bank might incur due to adverse changes in financial markets, such as fluctuations in interest rates, currency exchange rates, or stock prices. Investment banks, in particular, are exposed to this type of risk. Banks operate in highly regulated environments, and changes in regulatory policies can impose significant costs on their operations. Compliance with regulations like capital adequacy requirements, anti-money laundering laws, and data protection standards can be expensive and complicated. The rise of fintech, digital banking, and cryptocurrencies is changing the traditional banking landscape. While these innovations bring opportunities for growth, they also pose risks, such as increased competition and cybersecurity threats. Banks must continuously invest in technology to stay competitive and protect themselves from hacking, fraud, and data breaches. Banks are vital institutions that impact nearly every aspect of economic life. By understanding how they function, generate profit, and manage risks, individuals and businesses can better navigate the financial landscape and make sound decisions for their future.